Welcome back to GMS Podcasts. I'm Jamie Dalzell, head of the GMS Singapore office. Today, we're looking at one of the more counterintuitive developments in the ship recycling market. With the escalation around Iran and the continued uncertainty around the Strait of Hormuz, you would normally expect disruption to push more tonnage toward recycling. But interestingly, that is not what we are seeing. Supply is tight, freight is firm, older ships are still finding employment. Nayeem Noor, VP of Business Development at GMS, joins me to discuss what is really happening in the market. Nayeem, good to have you on.
Thanks, Jamie. Good to be here. And yes, you're right. This is one of those moments where the market is not behaving the way many people would normally expect. On paper, disruption should create recycling supply. But in practice, at least for now, the conflict has actually strengthened the commercial case for keeping a lot of older vessels trading.
Yes, and that is the part I find most interesting. In previous cycles, when you had a major geopolitical shock, the assumption was that some vessels would become uneconomic, displaced, or simply too difficult to trade. That would usually feed into the recycling market. This time, though, the opposite seems to be happening.
That's right. The immediate effect has not really been to remove ships from the market, it has been to improve earnings for many of them. Oil has been volatile, freight has remained firm, routes are longer, and risk premiums are higher. So instead of pushing older vessels out of service, the market is giving them another reason to stay in.
So the paradox is fairly clear. War is creating disruption, but that disruption is extending vessel life rather than shortening it.
Yes, that's a good way to put it. Owners are not looking at the uncertainty and immediately saying, let's exit. In many cases, they are asking a much more practical question: can this ship still earn? And right now, for a lot of older tonnage, the answer is still yes.
Which means the recycling decision gets pushed down the road.
It does. And that is where the frustration comes in for yards and cash buyers. The vessels are not gone. They are still trading, still earning, and in many cases, still passing the owner's commercial test. So, really, the market is not short of demand. It is short of available ships.
Freight is central to that. The Baltic Dry Index has been firming again, tanker earnings have stayed supported, and older tonnage that might normally be under recycling review is still finding employment. From a commercial point of view, that changes the calculation completely.
It does, absolutely. Freight is effectively overriding the recycling signal. Even if recycling yards are open, even if buyers have appetite, and even if steel prices give some support, the incentive to recycle is not there if the vessel can still generate acceptable returns. So, owners are not necessarily saying no to recycling. Increasingly, they are saying not yet.
And that not yet is what creates the holding pattern.
Exactly, that is the issue. It is not just a short delay, it becomes a broader deferral cycle. Once an owner sees another voyage or another fixture or another opportunity to keep the vessel moving, the recycling decision gets postponed again.
That is where I think the market can sometimes misread disruption. We see security risks, incidents, higher insurance costs, and route changes, and the instinct is to assume that ships will be forced out of trading. But shipping has always been very good at adjusting.
It has, and that is an important point. The disruption is real, but it is not automatically translating into recycling supply. Some smaller regional units and specialized vessels are being displaced, and some of those may move toward recycling destinations. But the larger LDT units, the vessels that really matter for yard utilization, are not coming through in meaningful numbers.
So instead of disruption creating recycling candidates, the fleet is being stretched into new employment.
Yes, in many cases. Vessels are being redeployed, routes are being adjusted, owners are finding alternative trades where they can. That flexibility is good for shipping, of course, but it is difficult for recycling markets because it delays the supply response.
And even when we hear about ceasefire discussions or partial de escalation, it has not really changed owner behavior.
No, not so far. And I think that tells us something important. If owners were genuinely ready to recycle, you would expect some movement once the market had even a little clarity. But that has not happened. So, this is not only about geopolitical risk, it is about commercial positioning. Supply is not structurally gone, it is commercially deferred.
That distinction matters. The ships are still there, but they are not available to the recycling market yet.
Yes, they are not gone, they are just not for sale.
Now let's bring in the recycling destinations. From what we are seeing, the regional picture is quite fragmented. Bangladesh has appetite and improving LC flow. India has the HKC platform. Pakistan has the Gulf proximity angle. Turkey remains mainly a regulated or specialist destination, but none of them can create supply on their own.
That's the key point. Bangladesh is probably the clearest example of demand without enough supply. Chattergram buyers have appetite, yard space has improved, and LC flows are moving better than before. But they still need ships. India has a different strength. Alang has the yards, the statements of compliance, and the track record for regulated tonnage. For European and Japanese owners, that matters. But again, compliance capacity only converts into volume when vessels are actually being sold.
And Pakistan is interesting because Gadani's geography matters more in this environment.
It does. Pakistan is definitely one to watch. Its proximity to the Gulf gives it a practical advantage for certain regional vessels. Pricing has also strengthened compared with earlier in the year, and HKC certified capacity is developing. But to be fair, there are caveats. Country risk, political sensitivity, and execution uncertainty still matter. So the opportunity is there, but converting it into completed transactions is the real test.
Turkey is a different case again.
Yes, very different. Turkey remains largely sidelined for mainstream tonnage because pricing is not competitive against the subcontinent. Aliaga still has a role, especially for regulated European tonnage or specialist cases where compliance overrides price. But for mainstream commercial recycling, it is difficult for Turkey to compete at current levels.
So each destination has its own story, but the shared problem is the same. The yards can be ready, buyers can be ready, but the ships have to be released by owners.
Yes, that sums it up well. And that is why pricing is also difficult. Buyers do not want to overpay when steel markets are uncertain. Sellers do not want to move too early if they think they can still trade the vessel. So you end up with hesitation on both sides.
And then there is the issue of war-damaged tonnage. It is not necessarily flowing into the market today, but at some stage, damaged, detained, abandoned, or commercially impaired vessels have to be dealt with.
Yes, and the industry needs to be careful there. War damaged ships are not normal recycling candidates. They can come with residual fuels, damaged structures, firefighting residues, uncertain inventories, incomplete documentation, and sometimes legal complications. So, when that tonnage eventually enters the recycling stream, it will need proper handling.
Which means capability matters, not just price.
That's right. Sustainable and compliant recycling becomes essential in that situation. If a vessel is damaged, unstable, or environmentally sensitive, the question cannot simply be who is paying the most. It has to be who can handle this responsibly.
So the conflict may be creating two separate effects. In the short term, it delays conventional recycling supply. In the medium term, it may create a more complex pipeline of casualty or damaged tonnage.
Yes, I think that is the right way to frame it. The immediate impact is delay. The longer term impact may be complexity, and the industry needs to be ready for both.
Which brings us to timing. Everyone in the market is asking the same question. When does this supply come back?
Yes, and there is no simple answer. Historically, there is usually a lag between disruption and recycling. Freight reacts first. Owners then reassess earnings, operating costs, insurance, class requirements, dry docking costs, and special surveys. Only when that balance shifts decisively does recycling supply begin to move.
So we should not expect an immediate wave of demolition candidates just because the geopolitical situation is unsettled.
No, I do not think so. The market has to work through the commercial logic first. Right now, that logic still supports trading for many older ships. But deferral is not disappearance. If freight softens, operating costs rise, or survey costs become harder to justify, the calculation can change quickly.
And when it changes, it may not be gradual.
That is the risk. You could see a more compressed release of tonnage once the economics turn. That is why recyclers need to stay disciplined now, preserve capacity, maintain pricing discipline, strengthen compliance, keep yard options open, because the shift may arrive with very little warning.
So if we step back, this is not a weak recycling market in the traditional sense. There is demand, there is appetite, there is compliance investment, but the supply side is being delayed by freight and geopolitics.
Yes, I think that is the right reading. This is not a lack of demand, it is delayed supply. And for recyclers, the challenge is to wait without becoming passive.
Patience, but not complacency.
Exactly. Or maybe better put, patience with preparation. The conflict has not opened the recycling floodgates. If anything, it has pushed them further down the road. The winners will be the players who keep their balance sheet, due diligence, and yard options ready while the market waits.
That is a strong note to end on. Naeem, thanks for joining us. Really useful discussion.
Thank you, Jamie. Always a pleasure.
And thank you for listening to GMS Podcasts. We'll continue to track how this develops in the weeks ahead.